Welcome back, everyone. Today, we need to talk about some big developments surrounding Bigbear.Ai, because the company's most recent financial update raised a lot of questions. Investors have been left scratching their heads, and honestly, there's plenty here that deserves a closer look. The management team laid out their numbers, and while it answered some questions, it also created new concerns. Most importantly, it gave us a clearer picture of why the stock has been falling so sharply over the past month. Let's break it all down, step by step. So, Bigbear.ai reported their second quarter revenue at $32.5 million. Now, at first glance, that might sound decent, but here's the catch. That's a decline of $7.3 million compared to the same quarter last year. For a company that many investors believed was on a solid growth trajectory, that kind of drop is a shock. This wasn't just a minor setback. This was one of the main drivers behind the sell-off in the stock. And it doesn't stop there. That revenue decline also pulled down the company's gross profit margin, which slid to 25% this quarter, compared to 27.8% a year ago. For context, a lot of people compare Bigbear.ai to Palantir, another big name in the artificial intelligence and data analytics space. But when you line up the numbers, the differences are striking. Palantir's margins are much stronger and, more importantly, trending upwards across the board. Bigbear, on the other hand, has seen its margins bouncing around unpredictably. One quarter looks okay, the next takes a step backwards. There's no clear long-term improvement here. What that tells me is this. Bigbear's business is still highly dependent on winning or losing individual contracts. When they land a big government program or enterprise deal, revenue spikes. When they lose one, revenue drops hard. It's been lumpy and inconsistent, and that's a problem for long-term investors who want stability and scalability. Now, why do people keep comparing Bigbear to Palantir? Simple. Palantir has been one of the great success stories of AI in the stock market. Its share price has climbed massively, and a lot of investors are hoping Bigbear might follow in its footsteps. The reality, though, is that the similarities are more about perception than actual results. Palantir has a proven track record of sticky customers, strong margins, and recurring growth. Bigbear? They're still struggling to prove they can deliver that kind of consistency. And speaking of struggles, the latest quarter also included a Goodwill impairment charge of $71 million. If you're not familiar, Goodwill impairment basically means that the company paid too much for past acquisitions or investments, and now those deals are not worth what they were supposed to be. When a company has to write down that kind of money, it's a sign of overly optimistic management decisions. This isn't the first time Bigbear has taken a hit like this either, and that's where investors are right to be cautious. Management clearly believed certain acquisitions would bring in strong returns, but as time went on, it became obvious that those expectations were overly rosy. In other words, the company itself was just as optimistic as the investors who bought the stock expecting fast growth. Both sides are now facing a reality check. What really raises eyebrows is that in the very same earnings call where they acknowledged this $71 million impairment, they also announced that they've raised nearly $300 million to pour back into new growth initiatives. To me, that feels a bit reckless. If your last round of growth-focused investments ended in a massive write-down, shouldn't you pause, analyze what went wrong, and maybe proceed more carefully? Instead, management seems determined to keep pushing forward at full speed because they've branded themselves as a growth company. But being a growth company doesn't mean you have to chase growth at all costs, especially if it means repeating mistakes. Another piece of the puzzle here is government contracting. Bigbear has leaned heavily on government deals, but those can be unpredictable. In fact, they recently lost a major Army contract. And on top of that, government efficiency reviews have labeled some of their deals as unnecessary spending. That resulted in cancellations, another blow to the company's revenue stream. For investors, this is worrisome. If your primary source of revenue is government contracts, and those contracts can be cut suddenly due to policy changes, you're left with a very unstable foundation. And yet, despite declining revenue, impairment charges, and lost contracts, Bigbear insists that the opportunities in AI are so significant that they will continue investing heavily for the rest of the year. The catch? Because of this spending spree, they've decided to withdraw their adjusted EBITDA guidance. What that means is they no longer want to give investors a timeline on when they'll hit profitability goals. Essentially, they're saying, we're going to spend big chasing revenue growth and we'll figure out profits later. From an investor standpoint, that's concerning. Growth is important, yes, but it's dangerous when it comes at the cost of financial discipline. If you're reporting revenue declines and impairment charges at the same time you're telling investors you'll double down on spending, that sends a mixed signal. It makes it hard to trust management's vision. Looking ahead, the company has revised its 2025 revenue projections. They're now expecting somewhere between $125 million and $140 million in revenue. But here's the kicker. That's actually a step down from the numbers they previously guided. So, even after raising hundreds of millions to chase growth, they're admitting that revenue 2 years from now will be lower than what they first promised. So where does that leave us? Bigbear.Ai is in a tough spot. They've got a lot of ambition, a lot of excitement around AI as a sector, and some investor enthusiasm simply because of comparisons to Palantir. But the numbers tell a different story. The company is dealing with declining revenue, inconsistent profit margins, big impairment charges, and unreliable contract pipelines. Management's insistence on reinvesting aggressively despite these warning signs could either pay off down the road or it could lead to more frustration for shareholders. At the end of the day, this isn't about hype. It's about execution. Big Bear needs to prove that it can build sustainable, predictable growth without constantly stumbling over lost contracts or disappointing financials. Until then, it's hard to see this stock living up to the lofty expectations some investors have placed on it. This is not financial advice.